If you had to predict the next closing value of the stock market and your whole life depended on getting the answer right, what would you say? Now imagine trying to make the same prediction for a year or 5 years or even 10 years' time. It's impossible to know what will happen in a few hours, let alone years. But that's exactly what investing forces us to do. Make decisions today based on a future we can't predict. And quite often, in a way, our lives do depend on it. Getting our decisions badly wrong will affect the quality of our future lifestyle. That's why we use rules of thumb and backward-looking data to come up with frameworks to keep us safe in the future. But the traditional rules are being tested in a world that's changing fast. So what does the new framework need to look like? In this video, I'm going to show you how to think about building a portfolio that can handle different environments, not just what we've been used to over the past 20 or 30 years, so you can feel more confident that your money is built to last, whatever the future throws at it. For a long time now, retirement portfolios have been built primarily around just two things: stocks and bonds. And historically, that's worked, because they've often moved in different directions when markets are under stress. But I've explained in recent videos that sometimes that relationship doesn't hold. And when it doesn't, diversification breaks down. So instead of relying on assumptions, I want to show you what's actually been happening. This chart shows some research we've conducted ourselves at Merenti Wealth Partners to show how major asset classes actually behave. In simple terms, whether they move together or behave differently. And the key idea is this: if one asset moves in a different direction to another, you get diversification. If they move together, you don't. Now the colour scale shows this clearly. Red means assets are moving together, and blue means they're behaving differently. The darker the red, the more correlated they are, and vice versa. And if we look at global equities, like the MSCI World and MSCI All Countries indices, and compare them to things like global bonds, UK investment grade bonds, and even property, you can see they've actually been far more correlated than most people would expect. In other words, many portfolios aren't as diversified as they appear. But you'll notice that I've blanked some of the lines out, and this one really stands alone. So let's focus on that first. What is it? Well, this line here shows commodities. Things like oil, gas, and industrial metals aren't driven by the same forces that drive stocks and bonds, which means they can behave very differently. And we've seen a good example of this recently. Here's an excerpt from a recent client report. And if we look at these two lines on the chart, which represent global equities in yellow and global commodities in blue, you can see that as stocks started to fall around late February, commodities started to accelerate sharply at almost the same time. That's diversification in action. Stocks were reacting negatively to rising costs, but the things causing those increases, energy and materials, were rising in value. It's simple supply and demand. Scarcity pushes prices higher. Now, we may not always see this kind of contrast. Diversification isn't a guarantee, and commodities don't de-risk a portfolio through their defensive characteristics in the way that bonds aim to. It's quite the opposite, in fact. They can be just as volatile as equities, if not more. Their value isn't that they're less risky, it's that they behave differently when it matters. Over the long term, it's likely that equities will still drive most returns, but having some exposure to assets like commodities can help when conditions change. It's a bit like being a racehorse breeder and owning 2 horses and a camel. Equities and bonds are like your racehorses, and commodities are your camel. If you knew you were only ever going to be racing at Aintree, you probably wouldn't need a camel. But if the environment shifts and all of a sudden you're having to race across the Sahara Desert, you might be glad you've got one. Another line that may have caught your eye on this chart is the red one. It had been on an incredibly strong run, and then its value dropped very sharply. So if you hadn't guessed already, this asset is gold. And a lot of people were confused when gold fell, because they'd been told it was supposed to be a hedge against inflation. So why did gold fall back just as we saw a spike in inflationary pressure caused by the escalation of conflict in the Middle East? Well, here's the distinction that most people miss. Gold doesn't respond to inflation. It responds to real returns on money. If interest rates rise faster than inflation, money in the bank or in bonds still earns a real return. And because gold doesn't produce income, it becomes less attractive. That's the main short-term driver of gold prices, and why it can fall even when inflation is rising. But there were other factors as well, like a strengthening US dollar and some general profit taking after a long rally. The Turkish government, for example, sold 118 tons of gold in March and converted that into US dollars, which they then sold to buy their own currency, the lira, to defend its value. The combination of all these things led to the sharp dip in the gold price that we can see here. But the bigger question is, does this signal the end of the gold rally? And should it still be included in portfolios? Well, this is where we need to zoom out a little bit and understand the reasons why gold went on such a strong run in the first place, and whether those reasons are still there as we look ahead. One of those factors is because investors were starting to question the stability of money itself, and this chart helps show why that is. This is the US federal budget going back to 1983. Anything below the line is a deficit, which means they're borrowing money. So what this tells us is that they run a chronic, policy-driven deficit, and have done for decades, almost without exception. This isn't cyclical. They borrow even during periods of strong growth and low unemployment. Is this just a US problem, though? Well, this very similar-looking picture of EU countries suggests otherwise. Western governments are fueled by debt, and there isn't much sign of that changing. Whenever the US gets near its debt ceiling, they just raise it or suspend it and kick the can down the road. But the real constraint isn't the debt ceiling itself, it's the market. If investors start demanding higher returns from US Treasury bonds because they think risk has increased, or if confidence in currency weakens, then holding physical assets like gold, which is a store of value, starts to make sense. So the key idea is this: different assets respond to different economic forces. And if all the assets in a portfolio respond in the same way to those underlying forces, it's not truly diversified. Like commodities, gold prices can be volatile. So when you're living on your capital and value stability becomes more important, they won't necessarily bring that. But some exposure could still be a good idea to help your portfolio respond to a wider range of economic forces. So what about bonds? After everything we've just discussed around debt and deficits, it would be easy to question whether they still have a place at all. But the answer isn't yes or no. It depends on which bonds you're using and how you're using them. Because bonds still play an important role in a portfolio. They're not there to drive returns. They're there to provide stability. But not all bonds do that equally well. One of the key things to understand is something called duration risk, which is essentially how sensitive a bond is to changes in interest rates. The longer the maturity, the more sensitive it is. And we saw the impact of that in 2022. Bond funds with a lot of duration fell sharply as interest rates rose, whereas shorter dated bonds held up much better. So if the goal is stability, shorter duration, typically 0 to 5 years, may offer more reliable defensive characteristics. Credit quality matters too. Lower quality bonds might pay higher income, but they tend to behave more like equities during stress periods, so they don't provide the same level of protection. Now that doesn't mean longer duration bonds don't have a place, because when interest rates fall, they can benefit significantly, like the reverse of what we saw in 2022. And this is also where bonds differ from cash. People sometimes ask me why we need to use bonds at all. I can get a similar rate of interest at the bank, so why don't I just do that? Well, it's because cash comes with something called reinvestment risk. If interest rates fall, your income goes down. There's no capital return element. Growth only comes from the interest paid, whereas bonds are traded instruments. They have a capital value as well as paying a fixed interest rate. So falling rates actually increase their value, which helps offset that risk. Another approach is what's called a gilt ladder, where people aim to use this capital return from bonds more so than the interest. You can purchase UK government bonds that were issued when interest rates were lower than they are now. When you buy them, it'll be at a discount to their original value, because their fixed income is now lower than what you can get from new bonds or cash accounts. If you hold the bond to maturity, though, the money that's paid back to you will be based on its original price, not the discounted price you paid. That means you get a guaranteed capital return. And what many people do is buy numerous discounted bonds that mature at staggered dates to give them a continual flow of money. The capital growth acts as a planned income stream. Now, because gilts are backed by the UK government, they're highly secure. Don't forget that the UK prints its own currency. So since the first gilt was issued in 1694, it's never failed to repay capital at maturity. The other attraction is that gilt maturities are exempt from capital gains tax. So for people who are in the higher rate tax bands, the effective return, once tax is accounted for, can be very appealing for a secure investment. Like we can see on this table of currently available gilts, not having to pay CGT means the effective return is equivalent to a much higher rate of interest. So each asset plays a different role. But if you're looking for a stable foundation within a portfolio, high quality bonds with a bias towards shorter duration can still serve that purpose. So where does all of this leave us? Well, a traditional two-asset portfolio, stocks and bonds, may not provide the same level of resilience it once did, especially when you're relying on that money to support your lifestyle in retirement. That doesn't mean throwing the baby out with the bathwater, though, and tearing everything up. It means building on it and refining it, adding carefully selected assets that behave differently and understanding why they're there and when they might struggle. Because ultimately, this isn't just about returns. One of the biggest factors in enjoying retirement is feeling secure, feeling like your plan will hold up. And that comes from two things: clarity and confidence. Clarity in how your portfolio is built, confidence in how it behaves in different environments. And they're built through understanding. Now, some people choose to get that through financial advice. And for many, that's absolutely the right route. But for others, it doesn't feel like the right fit. I've spoken to hundreds of people through this channel over the last few years, and I found that many would still value input and support, but not necessarily in the format of traditional advice. Perhaps they still want to remain independent and fully in control of their strategy, or they have simple requirements and just want to have a better understanding of retirement planning. That's exactly why we're building Sightable. It's the first offering of its type in the UK, and it combines knowledge, intelligent planning tools, and personal guidance from professionals in one place to help build that clarity and confidence and emotional security needed for a happy retirement. The whole process of creating a plan end to end and continuing to manage it over time is included in the framework. It's not about gathering assets, it's about developing a more complete understanding. So if you'd like to hear more about that ahead of launch, you can join the list in the description below. So building a portfolio isn't about predicting the future. It's about being prepared for it. And the more uncertain the world becomes, the more that approach matters. If you found this series helpful, I'd recommend watching this video next on the so-called AI bubble and what it could mean for your future. I'll see you there.